Trading instruments and risk management. Let's learn first what are the trading instruments that are available in stock market. Among the stock exchanges that we have, NSE is the most used by many participants. Due to this fact, there occurs constant buying and selling. So if there are more number of buyers and sellers, that means there won't be any problem in liquidity, meaning you don't get stuck with something, as there will be always someone at other end for you either to buy or to sell stocks. Most importantly, NSE got futures and options as trading segment, so we would mostly prefer to trade on NSE stocks rather than BSE. So the trading segments that we have are equity cash, futures and options. Let's see what equity cash is about. Okay, now say you have a trading account with rupees 10,000. You came across the fact that NSE has 2000 plus scripts to trade. Okay, how do we do it? Let's choose an example that you are currently aware of, Reliance, to demonstrate. Okay, so Reliance is trading at 950 and you have a capital of 10,000. How many shares can you buy with your capital? Simple answer would be 10,000 divided by 950, and that number is 10.52. But you cannot buy 0.52 shares, as shares are sold or bought in unit of 1. So we need to round the number. That would be 10 number of shares can be bought with your 10,000 capital. Shares bought are transferred to your demat account after 2 days and it stays as an asset. Okay, now your buy price was at 950. To make a profit, your selling price has to be what? Simple answer is obviously greater than 950. Now let's say price jumped upwards and is trading at 960 and you wish to sell at same price. What would be the profit? Simple maths, 960 minus 950 gives 10. That is 10 rupees, right? But you have to consider number of shares that you hold, which is also 10. So the total would be, profit would be 10 into 10, that is rupees 100. After that, you get your rupees 100 into your trading account and your account capital should grow by 100 as well. So adding that to your initial amount, or called principal amount, new amount would be 100 plus 10,000, that is 10,100. If I ask you what's the capital growth in terms of percentage, just divide total extra amount that you received here, which is 100, to the capital before the trade you took, that is 10,000. So that is 1% growth. You are a happy trader, earned 1% of capital with single trade. Good job. Now what we just saw was one side, the good side. Let's look other side as well. Had if the price went down instead going up, okay, now say 940 for instance, and you decide to sell it, it would be 940 minus 950. The value would be in negative, hence it is a loss. So the loss of minus 10 rupees. So your total number of shares, 10 multiplied by minus 10 would be minus 100, which means this money would be deducted from your total capital and your account value reduced to 9,900, in which you had 1% decline in your existing trading capital. Of course, you are going to be a sad person. Let's categorize what equity cash is about. In equity cash, you can only buy and sell later. You pay the exact price that share is trading at. The advantage of equity cash is you can vary the size of shares that you want to purchase based on your capital allocation. You can hold your shares until you die or until the company die. Okay, there is another segment called equity intraday cash. For that explanation, I need to define what intraday is. Intraday means trading position has to be closed by end of same day itself. You can't carry forward what you bought as intraday trade. For such trading, definitely you need two trading legs called a buy and a sell. Now you can take advantage of this by two types. Buy first, sell later. There is also another trade where you can sell first, buy later, end of day. Well, how is that possible? You can't sell something that you don't own, right? Well, here is the thing. Trading is a zero-sum game where one's share is transferred to other person, and this process of settlement happens after market hours by exchange. So in exchanges whatever you do before doesn't matter as in during market hours. So you can literally sell a product at higher price and buy back before end of day at lower price, making it seem like a normal buy and sell process. Right? Let me give you an example. Suppose, say a stock that is trading at rupees 100. Say price is an up move and you sell at rupees 110. This is normal buy sell where you earn 10 rupees as profit. So far so good, right? Now say you predicted the price to fall. You can sell at 110 and price moves down. You buy it back at 100, still you earn rupees 10 as profit. On both scenario, you bought the stock at lower price, the buy price being 100, and you sell price is higher than the buy price, that is 110. This transaction will happen during market hours, but at end of day when exchange allocates whom does the share belong to, all it needs is a buy and a sell process from traders. You have both, right? So this is possible only on intraday. So coming back, the process of buying first and selling later is called going long. It's a trader's language. When they feel price is bullish and when they expect it to happen, they say go long. And other way where sell first, buy later, it's called shorting or short. That is when price is expected to move down or be in bearish mode. Both long and shorts are irrelevant to trade being taken on positional or intraday. It is universal, okay? If expecting bull move, go long. If expecting bear move, short it. This brings us this table. So you can do two trading ways, long or short. Here for intraday, you can get money leverage, meaning from small money, you can have borrowed money from broker. That depends upon broker to broker. Okay, some broker gives 4 times, some gives 10 times, some gives 40 or 60 times. Let's take an example for leverage. Say you have a capital of rupees 10,000. Okay, this is standard. 10,000 is our course capital. A broker that gives a leverage of 10 times. Consider our previous example of Reliance itself, okay, that is being traded at 950. You can purchase 10 number of shares for 10,000 rupees, right? So with power of leverage, you can have a money control value of 10 times of 10,000, and that would be 1 lakh rupees. So for 1 lakh rupees, you can purchase 105 number of shares during intraday. So with respect to previous example, say price rose to rupees 960 and you get a profit of 10. So your total profit would be 1050. Now if it was a loss of 10 rupee, you get a loss of 1050. Your account size will be as shown. One would be above 11,000, other would be below 9,000. One got a growth of 10.5%, other got a 10.5% of decline. See, that's the power of leverage. It can be advantageous if you have the right direction and a catastrophic event during a wrong scenario. Now this brings back to this table. Definitely you can vary the size of quantity based on your leverage power that broker gives you. All positions has to be closed at end of day. This concludes equity cash segment. Let's move to futures. Now futures is also a trading segment in which you have to buy and sell. Here also you have the potential to go long or short irrespective of intraday or positional. When I say positional, it is basically holding more than one day. Futures are contracts, okay, and these are not shares. You are buying or selling the contracts only. A contract cannot be held forever. It will have an expiry. It is a similar case with your job, a loan or insurance policy. All got an expiry date. So here for futures, expiry will be 1 month, 2 month or 3 month. And I advise you to pick 1 month expiry alone as of now. Futures are derived from stock price. Okay, they are traded in lots. You can purchase any number of lots based on your capital you got. Lot size varies from stock to stock, and around 216 stocks are eligible for future trading, that is set by exchange at present. Let's see the example of Reliance itself. Okay, choosing contract would be the near contract, that is the near month, and the format would be Reliance and the contract date. Lot size of the Reliance is 1000 shares. The required amount to purchase and carry forward Reliance contract is around 1.2 lakhs, and that varies from broker to broker. Okay, and for an intraday trade, broker gives further leverage. Okay, and the cost would be coming under somewhere like 50,000. Now say the buy price is 950 and sell price is around 960. Your end profit is rupees 10. So based on your lot size, that is 1000, 10 multiplied by 1000 gives rupees 10,000 profit. Now other way, if you lose 10 points, it is rupees 10,000 minus. Okay, so one has a growth factor of 20% from investment and other got a 20% decline from the investment. See, wow, that was good, right? That's pretty much about futures, but we don't have to get inside futures. We shall focus only on equity cash because that's the best way without taking big risk to begin the trading world. Now one more segment is pending, which is called options. I'm not including options into this course as that itself will consume like 5 to 8 hours, and options are not meant for everyone. People lose money by just buying options mostly. I would advise everyone to start equity cash alone first. Let the account size grow significantly, then you can take step into future trading. Only if your capital is more than 3 lakh, I would recommend futures. Okay, otherwise stick with equity cash alone at always. Now let's see how to place a trade. Okay, suppose say a stock that is priced at 100 rupees CMP. Okay, you got a seller one who is offering you for 101 and you got a buyer who is bidding at 99. Now you being a fresh buyer who wishes to buy, now it's your decision. You can simply buy at the seller's price, which is 101. You can use an order style called market order. When you do a market order, the trade gets executed instantly with any price that is available in market where the seller happens to stay. In this case, it is 101. This was the scenario to buy one quantity. Now if you are using leverage and all, you would have higher quantity too, right? Say 1000 quantity for instance. Now the thing is, you executed at market order. So for one quantity to be filled, it was just one seller. Easily you got it. But now you need 1000 quantity. So when you executed market order, Of course, you will get all 1000 shares, but the buy price will vary. Let's see how so. Okay, for example, you got 500 shares from seller 1 and 200 shares from seller 2 at 102 and 300 shares from seller 3 at 103. Now collectively when you buy them, your average buy price would be up above 101.8, which is 80 paise away from the first seller at 101. It may sound just 80 paise, but when you have 1000 shares, it's 800 rupees difference right away just to buy. So in order to avoid such scenario, we have another type of order called limit order, where these orders are yet to happen. You place your buy level below the CMP zone and wait for a fill. You can give any number of quantity. It will fill at exact price whatsoever you mentioned. Of course, it takes time to fill up as you want sellers to come to your price, right? Now there is one more final type of order. Now say price is about to break out from resistance. You want to execute the trade once it broke out, but you can't keep on watching the screen forever until it breaks. So for this reason you use buy stop order. Say you want to get filled only when price reached 104. You just place a buy stop order and allow the price to reach you. Similar is the case for sell orders as well. During shorting of orders, you get market order, you can do limit orders, you can also do sell stop order. Okay, now say once you are inside the trade, you got the fill of required shares. What if it moves in wrong direction of your trade and you are making negative return? Don't you think you need to limit that loss part? To limit the loss, we use another order on opposite side to get out of the trade. This is called stop loss order. See, when you are in buy mode, you place your stop loss order below your buy level. When you are on sell mode, you need to place your stop loss order above your sell price. Stop loss orders are basically orders that are opposite to what you take. If you took buy, it is a sell order below your buy price, and if it is a sell, you have a buy order on top. Okay, so that summarizes these things. We just brushed into the concept called risk management with the introduction of stop loss. We enter a trade obviously to earn money, but what if the trade doesn't work in our favor? Shouldn't we limit the loss that we incur? Limiting the loss in a controlled manner and taking the trades is what risk management is about. Before entering the trade, we know what the potential loss that we might incur if the trade went in wrong direction of yours. And yes, this is done through stop loss orders. Okay, let us see these with an example. You have the initial capital as usual 10,000, and your broker gives you leverage of 10 times. See, you just learned it. So your power to buy or sell is 1 lakh rupees, and we are by default considering Reliance. For 1 lakh rupees money, you can buy 105 number of shares at 950 buy price. The buy price being 950. You wish to earn 10 rupees per share. So that means target is 960. And you intend to limit the loss as well by 10 rupees. The stop loss would be 940. Sounds like a good trading plan. Good job. So if scenario is profit, you shall earn 1050 totally, right? Because we just calculated earlier. That is your reward for your trade. And scenario 2, when price started to move downwards, since you want to limit the loss, you place your SL order. SL is stop loss at 940, and let's say it hit your SL, so for which you will be having a loss of 1050. That is the risk that you agreed before taking the trade. Now say you took another trade after you were a loss for same 10 points risk and 10 points profit. This time too you ended up with loss of 1050, and you kept on doing. to your bad luck, none of the trades worked in your favor. Okay, it's just assumption. On 9th or 10th trade, you are almost broke with no capital to trade thereafter. And you will be like, welcome to the club of wiping of account. It took only 9 bad trades to wipe off your account. Do you think this is good? A definite no. Let's change some trading plan now, okay? You previously lost money with 10 trades at max. Getting failure 10 times in a row is rare. After all, the only direction price can travel is up or down. That's when you make money. The outcome being that even if you gamble, you will get at least 50-50 chance, right? But we have to stack more edge in our favor. So why not increase the number of trades? Say 50 times. If you fail 50 times in a row, only then you wipe off your account. Let's keep it that way. And surely that won't happen ever to any traders. Failing 50 times in a row, no way. Okay, so we agree to let out loss 50 times. That means if we divide the total capital that we have, which is 10,000 rupees, divided by 50 times, that gives rupees 200. This 200 is the risk per trade, meaning if you make loss 200 rupees for 50 times in a row, only then you wipe down your account. That being said, it is impossible. Now back to our example regarding Reliance. Okay, Reliance buy price is 950. Now keep in mind, you are only supposed to make a loss of 200 per trade. Your profit is 960 level. Okay, so to limit the loss to 200, you are supposed to vary the quantity. To find the quantity, divide risk per trade money with difference in stop loss level and the buy level, which is 950 minus 940. Here we get the answer as 20. 20 is the number of shares that we can purchase. See, 20. Now suppose price climb to 960. You earn rupees 10 per share. In total your earning is rupees 200. Your reward is 200 and your risk was 200. Hence the ratio between them is 1:1. This is called a risk reward ratio. Now if you earn rupees 200 one time and lose 200 other time at end, you are still where you started. So in other words, a risk reward ratio where it is 1:1, it is just 50-50 chance that you will grow your account size. To start to grow your account size, your risk reward also has to be higher. For instance, say you are bullish, you are wanting to buy, okay, you know it will go towards 960 and your SL is 940. So say for instance the price came down towards 946, you can buy it, right? And at this point your profit will reflect in a different way and your number of quantities will also increase. Okay, at 946 you can buy total 33 number of shares. That means you get a profit of 462 and risk reward ratio is 1:2.3, meaning you risked rupees 1 and you earned 2.3 rupees. This means you have an edge in market. If you make loss twice for next 2 trades, you are still in profit, right? Your one single effort let you stay afloat on your capital even though you made 2 loss making trades. So it is essential to find cheap trades so that you have small SL and big targets. Then you can get good risk reward ratio. So in earlier example, what you did was adjusting the quantity based on your risk aversion. You tweaked the quantity of Reliance, that is called position sizing. Now, well done. You are coming good if you understand so far. Say while you are on Reliance trade, you find opportunity for 3 more potential trades on some other stocks. Guess what? You just invested all into Reliance. Oh no. What you missed right now is called allocation of fund. You should have reserve capital on your trading account. That doesn't mean you're supposed to add more fund. No. It simply means, you know, divide your capital into small parts. Say your account size is 10,000. Try and divide it into rupees 2,000 each. Say 5 times. Like so. Now add your broker's leverage. Okay, you get 20,000 rupees power per trade. Though you can divide as per your style. If you want to divide it into 10 equal parts, sure, go for it. Okay, or if not 20 equal parts, well and good. It's your account. That is called account management. So overall, you learned many aspects into trading. Okay, go through this over and over because very much essential is this part. Usually in other courses, this is the topic that is taught to you at last. But to me, this is the most important aspect for survival of being in trading world. Okay, good job coming so far. Let's see in other chapter.